Hi, this is Fred Phillips. Welcome to this video lecture relating to internal control, cash, and merchandising operations. Sales are governed by the revenue principle, which says that we should report revenues when they have been earned. Most merchandising companies earn revenues at some point between the receipt of a customer order and the receipt of a customer payment. Few companies consider their revenues to be earned at these two extreme points in time because the company does little work at that point in time. Typically, merchandisers record sales of goods when the goods are delivered to customers. Delivery can be defined as occurring at two possible points in time. One possibility is that the delivery occurs when the company ships the goods to the customer. Another possibility is that delivery occurs when the customer receives the goods that have been shipped by the company. The terms of sale distinguish between these 2 points, with the first being called FOB shipping point and the second called FOB destination. Under FOB shipping point, the seller is assumed to transfer ownership of the goods to the customer at the time they go on a truck, train, or boat to be shipped to the customer. Under FOB destination, the seller is assumed to own the goods until they finally arrive at the customer's premises. For most examples in this course, we'll assume revenues are recorded at the point of shipment, meaning FOB shipping point. The textbook explains that merchandisers can use either a periodic or perpetual inventory system. Our focus here is on the most common system, a perpetual inventory system, which, as the name suggests, perpetually updates the inventory account as any changes occur. So when we record a sale, we'll record two parts, the revenue that we've earned and the expense that we've incurred. The revenue is recorded at the selling price that we charge to the customer. In the example shown here, we sell a product to a customer at a price of $225. The impact of that part of the transaction is to increase our assets, specifically cash, by $225, and to also increase sales revenue by $225. The journal entry to record this part of the transaction is shown on the screen here. The second piece that we record is the expense, and we record the expense at the cost of the inventory that we've given up. The expense is called the cost of the goods sold, and its effect on the accounting equation is shown here. Reduction in inventory at the cost of the inventory to our company, and an increase in the expense, cost of goods sold, which has the effect of ultimately reducing stockholders' equity. The journal entry to record this part of the transaction under a perpetual system is shown on the screen. We will now look at three events that can cause adjustments to the original sale: sales returns, sales allowances, and sales discounts. Sales returns refer to the situation where the customer actually returns the product to us for a refund of the original selling price. In contrast, sales allowances refer to the situation where the customer keeps the product but is allowed to pay a lower price. Sales returns and sales allowances have slightly different effects on our accounting records. With a sales return, we first reduce the sales that we had originally recorded. That's the income statement account shown here on the right. And at the same time, we will give cash back to the customer if the customer paid cash and has the original sales receipt. If the customer did not pay cash, we'll reduce the amount that we show them owing us in accounts receivable. If the customer does not have the original sales receipt, we'll issue a gift card to the customer, recording it as an increase in unearned revenue. We will also add the product back into our inventory because it's been returned to us now, so it's ours again to sell to another customer. We put it back into our inventory account at whatever the item had originally cost us in the first place. Of course, since the sale no longer exists, we no longer need the cost of goods sold that was originally recorded, so we remove the cost of goods sold from the income statement account. In the case of a sales allowance, the customer actually keeps the product, but is allowed to pay us a lower price, so we will record only the first part that we recorded for a sales return. That is, we reduce our sales because we no longer have the sale at the original selling price. The customer ultimately is charged a lower price, and we will refund the cash to the customer, reduce our account receivable from the customer, or issue a gift card. Because we're not getting the inventory back in the case of an allowance, we have no change in the inventory account and no change in the cost of goods sold account. As a manager, you're going to want to know the extent of sales returns and allowances because they represent partial cancellations of our sales. To have this information available, we need our accounting system to not overwrite the initial sales, but instead to track sales returns and allowances separately and later subtract them from the sales account. So rather than deducting sales returns and allowances directly from the sales account, we use a contra-revenue account called sales returns and allowances, as shown here on the screen as SR&A. As the notation shown in parentheses indicates, sales returns and allowances is a contra-revenue account. By increasing the contra-revenue account, we decrease total revenues, which decreases stockholders' equity. We use this contra-revenue account for both sales returns and for sales allowances. The journal entries we use to record these financial statement effects are as follows. To record a sales return, we record a debit to sales returns and allowances at the selling price of the items returned. This debit increases the contra-revenue account, which ultimately decreases stockholders' equity. To record the decrease in cash or accounts receivable, we will credit whichever of those two accounts is appropriate. And anecdotally, had we issued store credit in the form of a gift card, we would have instead credited the liability account unearned revenue. When accounting for returns, we also have to record the inventory that we're getting back and the cost of goods sold that we no longer have because the sale was aborted. We debit inventory for the original cost of the inventory, and we credit cost of goods sold for this amount, which decreases that expense, thereby increasing stockholders' equity. Accounting for sales allowances is similar to sales returns, except that allowances do not involve a return of inventory, so we only account for the first piece, which is the reduction in cash or accounts receivable and the increase in the contra-revenue account, which has the effect of decreasing overall net sales. Notice that our inventory and cost of goods sold accounts don't change because the customer keeps the inventory. We're not getting it back when we grant an allowance. The final item that we'll look at are sales discounts. Sales discounts are given to customers to entice them to pay their account balances promptly after the sale. Note that these discounts are given after the sale has been made. These are not the discounts that reduce the selling price before a sale is made to entice the customer to purchase goods. As used here, sales discounts are given after the sale occurred to entice the customer to pay their account balances promptly. Sales discounts are commonly stated using the form shown here on the screen, 210N30. The first part of these terms refers to the discount percentage that is offered to the customer for the length of the discount period. In this case, the customer can take a 2% discount if the customer pays within 10 days of the date of sale. Otherwise, the net amount, represented by the letter N, must be paid after taking into account any returns and allowances. That net amount must be paid within the maximum credit period, 30 days in this example. Note that sales discounts are calculated as a percentage of the initial selling price after accounting for any sales returns and allowances that relate to the initial sale. That is, if we sell merchandise for $500 and the customer returns $300 of that original sale, the customer is entitled to a sales discount on the $200 balance that's still owed. Discounts also can be taken for partial payment of the total selling price. If a customer pays $100 of a $200 balance within the discount period, the customer is entitled to a discount on the $100 that is being paid. The seller accounts for sales discounts as a reduction in accounts receivable and as a reduction in sales revenue. But as we did with sales returns and allowances, we do not remove the sales discount from the sales account. Rather, we record a contra-revenue account called sales discounts. In the journal entry, we debit sales discounts, which increases the contra-revenue account and thereby decreases stockholders' equity. We also debit cash for the amount paid by the customer, and of course we record a credit to accounts receivable to reduce or eliminate the balance the customer owed. You've now seen lots of items that affect the income statement of a merchandiser, so here's a summary of them. The accounts shown in red represent accounts that are maintained by a company in its accounting system, but typically are reported only in income statements prepared for internal use, not for external distribution outside the company. The items shown here in blue are subtotals, not specific accounts. You should study this multi-step income statement closely. If you're asked to prepare an income statement in the remainder of this course, be sure to use a multi-step format such as this. That's the end of the video lecture for Chapter 6. As always, this video lecture did not cover all the details in your textbook chapter, so you should read it, and be sure to complete the recommended practice materials.